In this video, I'm going to show you how I made 700% return on a stock that is moving sideways. This is called the butterfly spread, and I'm going to show you how it's done. A butterfly spread costs very less compared to normal option trades. This is because we use a combination of buying and selling to offset the total cost of the trade. In this example, I just spent $1 per spread and I had opened 16 of them. For a total cost of just 28, right now this is worth 256. Can you imagine opening this many option contracts with just $28? The stock is only up 3% today, but my option spread is up 40%. Because of the way we set it up, the more the stock goes sideways, the more the spread will profit. I'm going to show you quickly how to set this up and what are the risks behind trading something like this. To do this effectively, you're looking for something that is moving sideways and also has high volatility. I'm going to go to trade options and show you what I mean. So if you see AMC, the current implied volatility is 300, which is very high. Normally for this stock, this is probably a lot less than what it is right now. With that opinion, now let's go and see how we can construct this. Basically, we're going to buy something just below the stock's price. So if this is at 460, I can probably try and buy this one, which is 450, or this one, 4. Now the next thing you want to do is sell something which is right next to it. So if this is a call butterfly spread, I'm going to go say sell and then select this one. This is basically a call spread that costs about 15 cents. Now the next thing I'm going to do is sell the next spread right next to it, which is basically you buy the next one and then sell one more of the $5 call. Okay, so what has basically happened here is I bought a call spread for 15 and then I sold another call spread for 14, bringing down the total cost to just 2 cents. If you do this on a stock that has low volatility like Bank of America, then this would cost much higher than what you see right now. So you're buying something that is worth 62 for just 1 cent, just because you sold more contracts further away. Now the best case scenario is as the stock keeps going sideways. Now the best case scenario is as the stock keeps going sideways like this, these options which are further out will become zero, leaving you with just this one, which would be worth much more than $2. And that is the whole idea. So if everything gets cancelled out or everything becomes zero, now if everything becomes zero or the stock breaches pass through everything, the maximum you could lose is maybe the $2 or $3 that you paid to enter into the trade. Now I'm going to say continue and see if I can get a fill here. Right now the current price is between 0 and 5. So what this means is that if I say 0.05, I would immediately get a fill. Now it has become 4. Okay, so if you are just learning, it is okay to just pay a little more and get a fill so you can look at how it's working. But the way I did that is I said I only want to pay 2 cents, and if I don't get a fill, I'm fine, I don't need it. So I did that and I got about 20 of them filled for an average between 1 and 2 cents. It's asking me if I want to do a debit or a credit, and here you have to say debit because you're paying $2 to open this. Now this might take 20 minutes or 30 minutes or 1 hour, or it will never get filled, but I'm fine. If it gets filled, I know I can get out with a nice win. If you see the 1 week performance of this butterfly spread, it basically has went from anywhere from 0.02, which is basically somewhere here is where I opened it, from 1 cent. Now it has gone all the way up to 17. As it gets closer and closer to the expiration date, which is Jan 29 here, it only increases more in value as long as the stock goes sideways. Now, if you want to close this, let's see how it works. So when you're closing, you have to take the asking price. So right now, the lowest you can get is 6 cents, and the highest you can get is 20. I have already put on an order for 15 cents. Usually, what I do when I get a fill, I just put the order for about 25% of the max profit. So if this spread is 50 cents wide, the 25% of it is just 12.50. So about 12 or 13 cents would be good. And trying to get anything beyond that is can get a little risky. I originally had 20 of this, and 4 of them already got sold for that price. Now I have another 16 left, and I have an order already pending to sell them. By putting an order as soon as you open it, you spend very less time looking at the trade. I have my own 9 to 5 job, and I just do this for fun. So I put this on and let it do its thing by itself. Now I hope you got an idea of how this works, and if you tried out this trade, let me know in the comments below how it went. And before I end the video, let's quickly look at the risk involved in this trade. It is very important to understand the risk behind options trading every time you put on a trade. When you're selling options, you're basically agreeing to sell 100 shares. So if I open 16 of this, I'm agreeing to sell 1600 shares of AMC. And since I don't have that in my account, the most important thing you should do is close this trade before the expiration date. If this ends on January 29th, I would make sure I will close it one day before or on the morning, just before I head out to work. You should never leave them open till the very last minute. The second risk to think about is early assignment. Sometimes earlier than Jan 29, I could be assigned to sell these 100 shares. This could normally happen when the company is paying out a dividend. So you have to be careful and make sure that there are no dividends coming out on that week. The third risk is when you let this too far away. If the stock goes all the way to 9 or 10, all these contracts are deep in the money and could result in early assignment. So if your opinion of the stock going sideways is no longer true, you just close this for a loss or a small win and get out of the trade. As long as you can do these things correctly and enter the right time, this is a very high profitable strategy and requires much less capital than the other option trades. If you like this video, smash that like button and subscribe to my channel, and I'll catch you in the next one.